This audiobook is written and produced by WealthBooks. From smoke-choked factories in 19th-century Pittsburgh to the gleaming boardrooms of modern Wall Street, the quest for fortunes has burned bright. Imagine standing shoulder to shoulder with John D. Rockefeller as he negotiates oil trusts, or watching Andrew Carnegie transform iron into steel empires. What if you could peer inside their playbooks, uncover the hidden patterns that propelled them to vast wealth, and apply those strategies to your own investments? In this audiobook, we unlock the vault, revealing time-tested principles, calculated risks, and visionary insights that will change how you view money and empower you to forge your own legacy of prosperity. Chapter 1. The Rise of the Tycoons. Imagine you're stepping off a rattling steam locomotive onto a muddy platform in 1870s New York. Around you, smokestacks billow and fortunes are made overnight. That's the world of Cornelius Vanderbilt, Andrew Carnegie, and John D. Rockefeller, men who treated business like a game of chess, not checkers. Today, I'm going to show you the exact moves they used, broken down into simple steps you can apply whether you're buying your first share of stock or launching a side hustle. First, let's talk focus. Vanderbilt built his empire by concentrating on one thing: transportation. He didn't scatter his money across a dozen industries. Instead, he studied steamships and railroads until he knew every rivet and timetable. Action step: pick one industry you understand. Maybe it's tech, healthcare, or even coffee shops, and spend 30 minutes a day reading trade news. Create a simple log. Date, key insight, one question. By week's end, you'll see patterns most people miss. Next, leverage. Vanderbilt borrowed heavily to buy competing lines, paying down debt with profits as traffic grew. Before you even think about margin or loans, make sure you have two things in place: a 3-month emergency fund and a clear repayment plan. Action step: draw a debt map, a list of any money you owe, interest rates, and minimum payments. Decide which to tackle first, highest interest, and set calendar reminders for automatic payments. You borrow smarter when you know exactly how fast you can pay it back. Carnegie's secret? Efficiency. He studied the Bessemer process for steel until he could run a mill more cheaply than anyone else. For you, efficiency means standardizing mundane tasks. Action step: pick one repetitive task, like tracking monthly expenses, and create a template. Use a spreadsheet with pre-filled categories and formulas. Next month, instead of starting from zero, just drop your numbers in and hit update. It saves you hours and makes your financial picture crystal clear. Let's talk partnerships. Rockefeller didn't hoard his knowledge. He formed the South Improvement Company, cutting secret deals with railroads to undercut rivals. You don't need under-the-table tricks. You need strategic alliances. Action step: list 3 people in your field who complement your skills. Send each a brief note proposing a knowledge swap. You share your expertise in exchange for theirs. It builds goodwill and puts you in insider circles where the best deals originate. Risk calculation sounds intimidating, but Rockefeller broke it down to simple math. If spending $10,000 on a new pipeline costs you $2,000 in shipping discounts, is it worth the investment? Do the same for yourself. Action step: before any purchase or investment over $500, write down 3 potential upsides and 3 possible downsides. Assign a rough probability to each, like 30%, 50%, 20%, and calculate the weighted outcome. If the upside outweighs the downside, go for it. If not, walk away without regret. Now, attention to detail. Carnegie walked every floor of his mills daily, inspecting boilers and talking to workers. You can't visit a steel mill, but you can audit your own operations. Action step: once a week, audit your spending. Grab your last 5 receipts, compare them to your budget categories, and adjust your plan. If dining out is creeping higher, swap one restaurant meal for a home-cooked dinner. Little course corrections keep you on track. The final move? Reinvestment. Every dollar Vanderbilt, Carnegie, and Rockefeller made got plowed back into growth, never just pocketed or wasted on extravagance. Action step: Automate your savings so that 10% of every paycheck goes into an investment account or your business expansion fund. Treat that transfer like a bill, non-negotiable. Over time, compound returns or reinvested profits become your silent partners, working while you sleep. So there you have it. Focus, leverage, efficiency, partnerships, risk calculation, operational audits, and reinvestment. These aren't vague theories. They're step-by-step rules inspired by the greatest wealth builders of the 19th century. Use them today to tackle your biggest pain points: lack of clarity, fear of borrowing, wasted time, and unpredictable spending. Follow these actionable tips, and you'll start thinking and acting like a tycoon before you know it. Chapter 2: Timeless Principles of Investing. You're about to discover 3 simple yet powerful rules that built America's greatest fortunes, and that can transform your own financial journey. Forget vague slogans or complicated charts. This is straight talk, clear steps you can take today to stop guessing and start growing real wealth. Rule 1 is diversify your portfolio. Back in Rockefeller's day, he knew better than to put every barrel of oil in one basket, and neither should you. Diversification isn't about owning every company on the planet. It's about spreading your capital across a handful of assets that don't all rise and fall together. Here's how. Pick 4 to 6 distinct buckets: U.S. stocks, international stocks, bonds or bond funds, real estate investment trusts, REITs, and a small slice of an alternative like gold or a tech-focused fund. Then automate it. Set up monthly transfers so that on the first of every month, you're buying a bit of each. This removes emotion, tames the buy high, sell low impulse, and build a cushion when one market stumbles. If U.S. stocks drop, your bond fund or real estate might hold steady or even climb, so you're not watching your entire nest egg vanish overnight. Rule 2 is invest for the long term. Andrew Carnegie didn't sell his steel mills at the first sign of a downturn, and you shouldn't panic sell when headlines scream recession. To make compound interest work its magic, you need time. Here's a concrete tactic. Decide on a commitment period, say 5 to 10 years. Then pick low-cost index funds or ETFs and refuse to look at your balance more than once every quarter. Set a calendar reminder. No checking the market unless it's review day. If you start obsessively refreshing your brokerage app, you'll chase performance, jump in and out, and incur fees that eat into gains. Instead, reinforce patience by tracking only your progress toward your long-term goal, maybe retirement, a down payment, or funding your child's education. When that goal is 10 years away, market swings, both up and down, become background noise rather than triggers for emotional decisions. Rule 3 is seek value and growth. Think like Carnegie searching for timbers along the Ohio River. You're looking for companies that the market undervalues today, but that have a clear edge for tomorrow. Here's an easy screening process you can use on any stock screener website. First, sort for low price-to-earnings ratios under 15. Next, filter for companies with return on equity above 12%. Finally, check that their debt-to-equity ratio isn't above 1.5. That gives you a short list of businesses earning real profits, managing debt responsibly, and trading at reasonable prices. Then drill down. Read the last 2 quarterly reports, glance at management's commentary, and decide if the core business makes sense to you. If you don't understand where a company makes money, it's not a safe bet. This approach keeps you focused on fundamentals, not guesswork or hype. Now let's address the elephant in the room: risk. Diversification, long-term thinking, and value screening all reduce risk, but you still need a plan for when the market hiccups. Before each automated purchase, decide in advance what you'll do if your overall portfolio falls 10%. Will you top up your contributions, shifting more money into beaten-down assets? Will you rebalance by selling a bit of your winners and buying more of the laggards? Writing this strategy down turns stress into action. When everyone else is screaming sell, you'll have a clear protocol to follow. No guesswork, no gut-churning fear, just a calm, predetermined response. And don't forget transaction costs. Today's low-fee brokers and index funds make frequent trading less tempting, but you still pay attention. If you're rebalancing monthly, Check that you're not incurring commissions or tax hits that outweigh the benefit. Many brokers now offer commission-free ETF trades. Take advantage. For taxable accounts, prefer funds with low turnover to minimize capital gains distributions. Finally, keep learning. The Tycoons read relentlessly, rocketing ahead because they understood industries before they boomed. You don't need a library of leather-bound books, but a 10-minute daily habit helps. Subscribe to one well-known investment newsletter, follow 2 reputable finance podcasts, and spend 5 minutes reading each morning while you drink your coffee. Over time, you'll develop an instinct for spotting changes in your chosen sectors and avoid the rookie mistake of chasing yesterday's winners. By following these 3 rules, diversify your bucket list of assets, commit to staying invested, and hunt for value with a simple screening process, you'll build a portfolio that weathers storms, captures growth, and grows quietly powerful over time. This isn't magic. It's the same hard-earned wisdom that built steel empires and oil trusts. And now it's yours, ready to work for your future. Chapter 3. Mastering the Art of Risk Management. You're in the trenches now. Money on the line. Heart pounding when a market dips 3% in a day. How do you keep calm, protect your capital, and even find opportunity when everyone else is panicking? Welcome to the no-nonsense guide to risk management, distilled from the playbooks of Vanderbilt, Carnegie, and Rockefeller, and translated into clear, actionable steps you can use today. First, let's talk position sizing. Imagine you're at a poker table. You wouldn't shove your entire stack on a single weekend. Treat each investment the same way. Rule of thumb: never risk more than 1 to 2% of your total portfolio on a single trade or investment. If you have $100,000 invested, your maximum drawdown per position should be $1,000 to $2,000. Why? That limit keeps one bad bet from wiping you out. If your stock falls 10% and you lose $1,000, your portfolio is still alive. Over time, this consistency wins far more than reckless all-in moves. Next, set concrete stop-loss orders. A stop-loss is an automated instruction to sell if a security drops to a price you choose. It's your silent bodyguard. Here's how. When you buy a stock or asset, calculate your maximum pain point, say 8% below your entry price. Place a stop-loss at that level. If the price slides to your limit, you exit automatically. No second-guessing, no emotional roller coaster. This simple rule keeps small losses small. Over hundreds of trades, the few times you get stopped out will feel painful in the moment, but they'll prevent the occasional 40% crash that really hurts. Now let's tackle hedging. Think of hedging like insurance on your house. You pay a small premium, so a big fire won't bankrupt you. In investing, you can hedge by buying put options, which rise in value when your underlying stock falls. If you own 100 shares of ABC Corp trading at $50, you could buy a put option with a $45 strike price. If ABC dips below $45, the put gains value and offsets your paper loss. Yes, you pay for the option, typically 2 to 4% of your position size per month, but that's the cost of peace of mind in volatile markets. If you're not comfortable with options yet, you can also hedge by shifting a small portion, 10 to 15%, of your portfolio into assets that historically move opposite the market. Think gold, treasury bonds, or even volatility ETFs. Next up, shadow the Tycoon's curiosity about technology. When Andrew Carnegie saw the potential of the Bessemer process for steel, he dove in headfirst. Today, you don't need a lab. You just need a little planning and a trusted source of news. Set aside 1 hour each week to read up on your chosen innovation, whether it's artificial intelligence, renewable energy, or blockchain. Subscribe to one specialist newsletter, e.g., the Information for Tech, Energy Transition Podcast for Renewables, and bookmark one reputable website, like EE Spectrum or CoinDesk. Then, pick one concrete action. Buy a tiny stake, 1 to 2% of your portfolio, in a well-established ETF or blue-chip stock that's leading the innovation. You're not shooting the moon. You're dipping a toe into tomorrow's biggest opportunities. Feeling overwhelmed by jargon? Here's a quick cheat sheet. If a term sounds like it belongs in a chemistry lab, quantum computing, gene editing, decentralized finance, Just write it down and Google it for 5 minutes. You'll be amazed how fast the fog clears once you've read a 300-word explainer. Knowledge is your shield. Once you understand the basics, deciding whether to invest becomes simple. Finally, never underestimate the power of connections. The Tycoons didn't go it alone. They formed alliances with bankers, politicians, and rivals to secure railroad charters or oil pipelines. Today, your railroad charter might be an insider tip on a promising IPO or an introduction to a fund manager at a conference. Action step: join one focused investing community or club. Whether it's an online forum like Bogleheads, a local meetup via meetup.com, or a paid newsletter with a Discord server. Then, reach out personally to one member each month. Ask a question, share a resource, or offer to grab coffee. These small gestures build goodwill. Over time, you'll find yourself on group calls where actionable tips flow freely, mistakes are called out early, and blind spots get filled in by wise friends. Risk management isn't about eliminating all risk. That's impossible. It's about controlling the variables you can and staying calm when storms hit. Keep your position sizes small, use stop losses, hedge selectively, stay curious about innovation, and lean on your network for perspective. Follow these steps, and you'll not only survive market tumbles, you'll thrive, spotting discounted opportunities while others panic, just like the Tycoons did in their day. Master your risk, and wealth follows. Chapter 4. Building a Sustainable Financial Foundation. All right, let's get real. If you're tired of wondering where your paycheck disappears each month, or you've sworn off impulse buys only to cave 5 minutes later, this chapter is your playbook. We're not talking about vague, just save more pitches. We're breaking down exactly how to build a money system that works, even when life tries to wreck it. First off, automate everything. Open your bank app right now. Set up automatic transfers on payday, 10% into savings, 10% into investments, and 5% into a fun account. If you wait until month end, you'll spend it. By automating, you force yourself to live on what's left. Pain point solved, you'll stop forgetting to save and end up broke by the 20th. Next, track every expense. Yes, every coffee, every Uber, even that 99-cent app game. Download a free expense tracker like Mint or use the Notes app on your phone. For 1 week straight, write down or snap a pic of every single thing you buy. At week's end, sort them into essentials, rent, groceries, utilities, and wants, streaming, takeout, impulse buys. You'll be surprised how 5,500 Nigerian Naira's coffees add up to a car payment. Once you know exactly where your cash leaks, you can patch them. Now let's talk budgeting simplified. Forget complex spreadsheets. Use the 50/20/30 rule. 50% for needs, rent, bills, groceries. 20% for savings and debt paydown. 30% for wants, dinners out, new shoes. If you make 200,000 Nigerian Nairas per month, that's 100,000 Nigerian Nairas for needs, 40,000 Nigerian Nairas for savings/debt, and 60,000 Nigerian Nairas for fun. Adjust the percentages if you're aggressively paying off a loan, but stick to something clear. The simplicity removes decision fatigue. No more guessing if you can afford that pizza. On to investing basics. You don't need an MBA to start. Open a low-fee brokerage or micro-investing app that lets you buy fractional shares from 1,000 Nigerian Nairas. Commit to a recurring buy, say 5,000 Nigerian Nairas every 2 weeks into a broad market ETF. This removes the anxiety of timing the market and turns investing into an automatic habit. Pain point. You'll stop staring at candle charts and stressing over every dip. But dumping money into the market isn't enough. You need emergency cash. Aim for 3 months of living expenses parked in an easy access account. If your monthly bills total 80,000 Nigerian Nairas, you need 240,000 Nigerian Nairas sitting ready. Treat this like a non-negotiable monthly bill until it's full. Once you build it, the stress of what if the fridge dies vanishes. Let's address financial literacy without the jargon. Pick one book, no more than 200 pages, like The Richest Man in Babylon or I Will Teach You to Be Rich. Read 1 chapter per week before bed. That's 20 minutes. Schedule it Tuesday and Thursday nights. You'll build a foundation without swatting at endless articles. Pain point. You'll stop feeling lost in the finance speak swamp. Now, for the toughest part, cultivating discipline and patience. Markets wobble, bills surprise you, friends tempt you to splurge. The antidote? 1% improvements and a roadmap. Set a 12-month goal. Pay off 200,000 Nigerian Nairas of debt. Save 100,000 Nigerian Nairas, or build a 500,000 Nigerian Nairas investment nest. Break it into monthly checkpoints. 16,700 Nigerian Nairas debt paydown, 8,300 Nigerian Nairas saved, 41,700 Nigerian Nairas invested. Mark these in your calendar and review progress on the first of every month. If you miss a target, don't beat yourself up. Adjust next month's numbers, but keep moving forward. That consistency compounds just like interest. When temptation strikes, let's do a weekend getaway. Pause and ask, is this aligned with my goal? If not, adjust your discretionary budget or choose a cheaper activity. Maybe a picnic instead of a hotel. Pain point, you'll learn to say no without feeling deprived. Finally, build accountability. Tell a friend or partner your goals. Better yet, join an online group or WhatsApp chat where everyone checks in weekly. Post your victories, debt down by 10,000 Nigerian Nairas, and your struggles. Having someone outside of you who cares is like having a coach who won't let you quit. Here's the bottom line. Complex money myths don't pay the rent. You need a clear, automated system, real-time tracking, simple budgets, emergency cash, and a bite-sized learning plan. Then hammer it home with discipline, monthly check-ins, and an accountability network. Do these steps consistently, and you'll wake up one day realizing you've built a fortress, a financial foundation that not only survives but thrives. Chapter 5. Harnessing the Power of Leverage. When most people hear leverage, they picture high-risk gamblers and margin calls that wipe out savings overnight. Let's cut through the noise. Leverage is simply using other people's money or future cash flows to help you build wealth faster. Done right, it turbocharges returns. Done wrong, it digs a hole you can't climb out of. Here's the no-fluff guide to using leverage without losing your shirt. Think of leverage as a tool, like a hammer. You wouldn't swing it blindfolded, so don't borrow blindly. Rule 1. Only borrow for assets you completely understand. If you've never bought a single share of stock, don't open a margin account just because your friend did. Learn the basics first, then borrow. Real-life tip. Fund a small margin account with $2,000. Buy one or two blue-chip stocks you know. Think Coca-Cola or Microsoft. Watch how interest accrues daily. If you can handle that, you're ready to upscale. Rule 2. Always calculate your break-even rate. If you borrow at 6% interest, your investment needs to return more than 6% after fees to actually grow your net worth. Simple math. If you borrow $10,000 at 6% and invest in an ETF yielding 8%, your real gain is 2%, not 8%. Actionable tweak. Use an online loan amortization calculator to plug in your rates and see at what return you profit. If you can't beat that number consistently in backtesting, hold off. Real estate borrowing follows the same principle, but with its own rules. Rule 3. Treat a mortgage like a forced savings plan. You put down 20%, borrow 80%. If your rental income covers all expenses plus mortgage payment, that's positive leverage. Your tenant pays your debt. Pain point. Unexpected repairs. Counter this by setting aside at least 5% of monthly rent in a maintenance fund. That way, a $2,000 HVAC repair doesn't derail your cash flow and force you to tap into personal savings or refinance at a higher rate. Leverage partnerships are another avenue. Syndicates, private deals, or small business loans. Rule 4. Partner with people who bring expertise or capital you lack. If you're great at marketing but have zero construction knowledge, don't finance a fixer-upper alone. Find a partner who handles build-outs, and you handle tenants and rent collection. Draft a simple operating agreement that spells out profit splits and responsibilities. Pain point. Partners who vanish when things go south. Actionable safeguard. Stipulate in writing that each partner must maintain minimum cash reserves and performance bonds, so nobody ghosts when the roof leaks. Options and derivatives can be leveraged too, but they come with lightning-fast gains and losses. Rule 5. Use covered strategies, not naked ones. Instead of buying risky naked calls, write covered calls on stocks you already own. That means you collect a premium up front and only risk selling shares you intended to own anyway. Real life hack. Take 100 shares of Apple you've held for a year, sell 1-month calls at a strike 5% above today's price. Collect that premium like rental income. If Apple jumps, your shares get called away at a profit. If it falls, you keep the premium cushion. Across all these tactics, you need crash-proof safeguards. Rule 6. Implement automatic stop-loss or margin alerts. Most brokers allow you to set an alert at 25% equity drawdown. When you hit it, you get a text. Actionable step? Log into your brokerage today, find alerts in settings, and create one for both price and margin threshold. That little ping can save you thousands by forcing a manual review before a full meltdown. Finally, leverage only what you can service comfortably. Rule 7. Cap your total debt service at 25% of your monthly income. If your job pays $5,000 a month, don't spend more than $1,250 on all loan payments combined. This buffer means a temporary job loss or market slump won't push you underwater. Real-life checklist. Tally credit cards, car loans, mortgage, margin interest. Divide the total by your monthly income. If you're over 25%, pay down or refinance high-interest pieces first. Leverage isn't magic. It's math and discipline. Treat it like a power drill. Know the drill bits, study the manual, never point it at your foot. Follow these 7 rules, and leverage becomes your ally, not an enemy lurking in the shadows. You'll build wealth faster, but without sleepless nights. Now go ahead, choose one rule, apply it today, and watch how a measured step into leverage can move your financial needle. Chapter 6. Weathering Financial Storms. Picture this. It's October 1873. The panic hits like a freight train. Banks collapse, railroads shudder, fortunes evaporate overnight. Vanderbilt watches his shipping profits vanish, and then doubles down on discounted bonds. Fast forward to today, and the headlines scream the same story. Markets crash, portfolios bleed red, and panic sets in. But here's the no-nonsense truth. Downturns aren't warnings to hide under the bed. They're invitations to act. In this chapter, you'll get simple, specific rules you can start using now to not just survive financial storms, but thrive through them. Rule 1. Build a 6-month cash cushion. When your paycheck stops or you need to buy low during a crash, cash is your ammunition. Aim to stash away enough to cover living expenses for 6 months. Action step. Set up an automatic transfer, 5% of every paycheck, into a separate high-yield savings account labeled market ammo. Treat it like rent or groceries. It's non-negotiable. When panic hits, you won't be forced to sell stocks at a loss to pay the bills. Rule 2. Tier your exit strategy. Andrew Carnegie didn't dump all his steel holdings at the first sign of trouble. He sold in batches. Modern tip. Use tiered stop-loss orders set at 10% and 20% below your purchase price. When the 10% level triggers, sell 1/3 of your position. At 20%, sell another third. The rest stays put unless something truly catastrophic happens. This approach locks in partial gains, preserves capital, and lets you stay in the game. Rule 3. Keep a buy-ready watch list. Tycoons kept notebooks filled with potential investments, railroad lines, oil fields, steel mills. Today, maintain a list of 5 to 10 quality stocks or ETFs you'd buy if prices drop 15 to 30%. Every quarter, spend 10 minutes checking their earnings, balance sheets, and recent news. When one slides into your target price, pull the trigger. No endless scrolling, no emotional paralysis, just pre-planned opportunity. Rule 4. Bucket your portfolio. Divide your money into 3 buckets. Income, dividend stocks, bonds, growth, blue chip equities, ETFs, and opportunity, cash plus that watch list. Keep roughly 50% in income, 30% in growth, and 20% in opportunity. When markets tumble, money flows from income and growth buckets into opportunity. No brain-melting decision-making required. Rule 5. Embrace volatility as a friend. Vanderbilt bought cheap bonds in 1877 when rail profits dipped. Rockefeller snapped up oil refineries during price wars. Volatility isn't your enemy. It's your discount sale. When a market swings more than 5% in a week, review your watch list. If your target price is hit, execute a small purchase, 2 to 5% of your opportunity bucket. Then walk away. Rinse and repeat. You'll average a better price over time. Rule 6. Conduct a fear versus reality check. Panic feels like doom, but rarely is everything collapsing. Ask yourself 2 questions before any trade. What's my worst-case loss? And can I live with that outcome? If the answers are yes and yes, act. If not, don't. This simple filter stops emotional overreactions. No need for complex risk modeling or expensive subscriptions. Rule 7. Use dollar-cost averaging with a twist. Instead of equal monthly buys, adjust your contributions based on market moves. For every 10% drop in your growth bucket year-to-date, increase your next purchase by 1%. A 30% decline means you buy 30% more than usual. This tactic systematically buys more when prices are low without requiring perfect market timing. Rule 8. Debrief after every crisis. After the panic of 1893, Carnegie studied exactly which investment held value and which fell hardest. After COVID-19's March 2020 crash, the same exercise applies. Review each position that lost over 15%. Did it recover? Did fundamentals change? Use that intel to refine your watch list and bucket allocations. Schedule a 30-minute market postmortem within 60 days of any 10% plus correction. These 8 rules aren't academic. They're battle-tested blueprints. When markets tumble, you'll have a concrete playbook, cash reserves at the ready, partial exits organized, pre-selected targets queued up, and emotional triggers neutralized. Instead of doom-scrolling headlines, you'll be executing pre-planned moves. Remember, storms expose weak foundations, but they also reward the prepared. Weather the next crash like a tycoon, steady, strategic, and ready to turn panic into profit. Chapter 7. Legacy, Philanthropy, and Ethical Wealth. You've built your fortune the hard way. Late nights, smart bets, tough calls. Now it's time to think beyond the bottom line and ask yourself, what footprint will I leave behind? Real legacy isn't a fancy building with your name on it. It's the positive change you spark in people's lives. Let's break this down into 3 simple, no-fluff steps you can start using today. First, get laser-focused on your core values. Don't pin giving back on a vision board and forget about it. Pick 1 or 2 issues you actually care about: education, clean water, mental health, whatever lights a fire under you. Then, write down a clear mission statement. I will improve X for Y people by Z date. That little formula forces you to stop talking and start doing. Keep it on a sticky note above your desk and review it every quarter. If you can't recite it in 10 seconds, you don't own it yet. Second, structure your giving like you manage your investments. Billionaires like Carnegie and Rockefeller didn't just cut checks and call it a day. They created foundations with boards, budgets, and milestones. You don't need a PhD in nonprofit law, just these 3 building blocks. Set a giving budget. Decide on a fixed percentage of your annual income or net worth. Treat it like a recurring bill, non-negotiable and automated. Choose high-impact partners. Look for small, nimble organizations doing measurable work in your chosen field. Demand quarterly reports, not flowery newsletters. Define success metrics. Instead of helped kids, aim for raise graduation rate from 70% to 80% in District X over 2 years. If you can't measure it, you can't manage it. Next, embed feedback loops into your philanthropy. Every dollar you give should teach you something. Host a 30-minute call with your partner organization every 6 months, ask for hard data, and challenge them. Why didn't we hit our target? Then tweak your budget or switch partners based on those answers. This cycle, plan, execute, review, adjust is the same ruthless efficiency you use in business. Apply it religiously to your giving. Now, let's talk about mixing profit motives with purpose without looking like a snake oil salesman. Impact investing isn't just a fancy buzzword. It's a way to funnel capital into companies that do good and make money. Here's how you start. Screen for ESG basics. Before you buy a stock or fund, run a quick check. Do they score above average on environmental, social, and governance indices? Free sites like MSCI ESG or Morningstar give you a snapshot in minutes. Allocate a mini purpose portfolio. Take 5 to 10% of your investable assets and commit them to impact funds or green bonds. Label it and forget it for at least 3 years. When you check performance, you'll see how much purpose and profit can coexist. If you already own a business or run a family office, weave ethical guidelines into your corporate DNA. Draft a one-page code of conduct. We will never source materials from suppliers who violate human rights. We will invest 2% of profits into community projects annually. Post it publicly on your website and share it with employees. Accountability breeds action. Finally, secure your legacy by getting your family on board. Money tears families apart when there's no plan. Host a quarterly family council. Think of it like a board meeting, but with pizza and no PowerPoints. Use these gatherings to educate the next generation on your mission statement. Involve them in site visits and let them pitch their own mini-grants. That way, they inherit more than dollars. They inherit purpose. Put all of this into a simple governance charter. Who decides how often you give and how you measure success? Get it signed and notarized. Building ethical wealth isn't about public praise or social media clout. It's about weaving impact into every dollar, every decision, and every conversation you have about money. Start today by choosing your focus, setting up structures, demanding accountability, and bringing your family along. That's how you turn wealth into a living, breathing legacy that outlasts your own lifetime. Chapter 8. Conclusion. Charting your path to lasting wealth. You've just journeyed through the raw blueprints of America's richest visionaries, distilled into 8 simple rules. Now it's time to tie it all together. Imagine you're standing at a crossroads. Behind you are decades of compounded gains. Ahead lie fresh opportunities. Your challenge is simple. Apply what you've learned today, every single morning, to build a portfolio that works even when you don't. First, wake up with a clear daily check ritual. Skip the financial news ticker. That's noise. Instead, spend 5 minutes reviewing one core metric, your asset allocation. If stocks, bonds, and real estate drift out of balance by more than 5%, make a small trade to rebalance. It's not about guessing the market top or bottom. It's about keeping your house in order. Next, pick one undervalued asset each quarter and dig in. Don't overwhelm yourself with 100 potential picks. Choose one, a stock, a REIT, or even a peer-to-peer loan platform you understand. Scan its fundamentals, revenue growth, profit margins, and debt levels, and compare them to 3 top competitors. If it beats them on 2 out of 3 metrics, consider a starter position. That single habit transforms hope into system. Then, set up a stop-loss rule that you actually follow. If an investment drops by more than 15% from your purchase price, sell half your position. Why half? You lock in losses while still leaving room to ride a potential rebound. If it rebounds by 20%, buy back the half you sold. This rule tames fear and greed, 2 emotions that destroyed more portfolios than market crashes ever did. Every week, connect with one person in your network who's smarter about money than you are. It might be a financial blogger, a local accountant, or a friend who's crushing real estate deals. Send a quick message. Hey, saw your latest thought on X. Mind if I pick your brain for 5 minutes? Those 5-minute chats compound faster than any investment. Remember, your network is your net worth. Set aside 1 hour each month for innovation research. That means reading about one new technology or market trend, blockchain, green energy bonds, AI-driven funds. But here's the actionable twist. After reading, Write down one concrete way you could apply it to your portfolio. Don't just note that AI is booming. Ask yourself, can I allocate 2% of my portfolio to an AI ETF or a startup crowdfunding campaign? That note becomes next month's experiment. Build a simple spreadsheet that tracks not just returns, but emotional responses. For each trade you make, jot down in 2 columns, why I bought and how I felt. After 6 months, review the journal. You'll spot patterns. Maybe you panic sold at lows or chase morning hot tips. Those insights are your gold mine. An audit of your emotions helps you refine discipline. Address the biggest pain point most investors face, the lure of get-rich-quick schemes. When you feel the itch to chase a flashy tip, pause and ask yourself 3 questions. 1. Have I studied the fundamentals? 2. Does this fit my long-term plan? 3. Can I afford a full loss? If the answer to any is no, walk away. Literally close the browser tab and go for a walk. You'll save thousands in impulse losses. Finally, turn these rules into habits by linking them to daily triggers. For example, tie your daily check to your morning coffee. Attach your weekly network message to Friday afternoon when everyone's winding down. Anchor your monthly innovation research to the first weekend of the month. By embedding actions into existing routines, you'll build a machine that runs on autopilot, not willpower. Today, you close this book not just with ideas, but with a clear action plan. You've learned to diversify with intention, invest for the long haul, manage risk like a pro, embrace innovation, and forge relationships that amplify your success. These aren't vague mantras. They're simple rules you can start using tomorrow morning. Now, take a deep breath, open your brokerage app, and set your first rebalance alert. Your lasting wealth is waiting. The end. We hope you've enjoyed the audiobook. This audiobook is a production of WealthBooks. Copyright 2025.